Oil prices are holding steady, but beneath the surface, a storm of geopolitical tensions and economic shifts is brewing. Here's the catch. The US and China have agreed to prolong their temporary halt on escalating tariffs until November 10th, a move that's sending ripples through global markets. But here's where it gets controversial. How will this pause in tariffs truly impact oil demand? And is the world ready for the next round of trade wars? Let's break it down. The United States and China have extended their tariff truce, staving off a potential surge of punitive duties on Chinese goods. This decision comes as U.S. retailers gear up for the holiday shopping season, a critical period for global supply chains. Analysts argue this pause could pave the way for a broader trade agreement between the two economic giants. However, the elephant in the room remains. If tariffs are reinstated, they could slow global growth, which in turn might dampen fuel demand and drag oil. But what if the real story isn't about tariffs at all? What if the true wild card is the upcoming Trump-Putin summit in Alaska? And this is the part most people miss. Friday's high-stakes meeting between U.S. President Donald Trump and Russian President Vladimir Putin could upend the oil market. The two leaders are set to discuss a potential ceasefire in Ukraine, a conflict that's already reshaped global energy dynamics. Trump has made it clear, Russia must agree to peace by Friday, or face secondary sanctions on its oil buyers. He's also pressured India and China to cut back on Russian oil imports. But here's the twist. What if a peace deal emerges from Alaska? Could that reshape the global oil landscape overnight? Commerce Bank warns that if no progress is made, even tougher sanctions on countries like China could follow. Should we be worried about a new front in the oil war, or is this just political theater? Meanwhile, OPEC is painting a cautiously optimistic picture for 2026. The organization has upgraded its global oil demand forecast by 100,000 barrels per day, now predicting a 1.38 million BPD increase next year. This revision comes as OPEC trimmed its growth projections for non-OPEC Plus producers, including the U.S. The message is clear. The market is tightening. But here's the question that divides experts. Can OPEC's optimism hold if geopolitical tensions escalate further? And what happens if the U.S. shale industry ramps up production to fill the gap? The answers might lie in the next few months. To add fuel to the fire, U.S. consumer prices rose in July, partly due to tariff-driven inflation. This data point could influence how central banks approach interest rates, which in turn affects oil demand. But let's not forget the bigger picture. The world is at a crossroads. Will trade wars and geopolitical brinkmanship dominate the next chapter of the oil story? Or will cooperation and stability take center stage? We'd love to hear your take. Do you think the current pause in tariffs is a sign of progress or just a temporary reprieve? Share your thoughts in the comments below.